all need to make smart decisions with our money. The Long-Term Investor Podcast shows you how by distilling complex financial matters into easily digestible lessons. And now, here's your host, Chief Investment Officer at PlanCorp and the author of Making Money Simple, Peter Lazaroff.
Welcome to the world of taco investing, where Trump always chickens out, a phrase capturing the volatile cycle of aggressive policy threats followed by sudden reversals. In this episode, we're going to use the taco phenomenon as a lens to explore how investors can better understand and navigate short-term market swings caused by political news. You'll learn why markets often overreact to political headlines, the critical distinction between the economy and the stock market, and key strategies that successful investors use to manage short-term uncertainty. So join me to uncover how to thrive in a market dominated by policy whiplash and why staying disciplined matters more than ever. As always, you can find detailed show notes at thelongterminvestor.com, and at the top of your podcast episode description, you will see a link to sign up for exclusive offers related to my new book, The Perfect Portfolio, that is due out in the summer of 2026. Now, today we're talking about a phrase that's become popular in both financial circles and online, and that's taco, or Trump always chickens out. Coined by Financial Times columnist Robert Armstrong, this phrase describes a pattern we've seen repeatedly. President Trump announces aggressive tariffs or economic policies. Markets immediately react negatively, only for him to quickly soften or reverse his stance. And while the term itself isn't crucial, its popularity, I think, provides us an opportunity to reflect on how policy decisions can influence short-term market movements. And by examining these reactions, we can better understand the broader implications for long-term investors and explore strategies for navigating similar situations in the future. This taco effect, it is not new. As the columnist from the Financial Times pointed out, there are a few specific historical examples. In 2018 and 19, during the last Trump presidency, there were some tariffs announced at China, and stocks in many sectors plummeted, but they only recovered swiftly when those threats were delayed or scaled back. We also saw this in June 2019 when threats to impose tariffs on Mexico over immigration led to some immediate market drops, only to see those threats reversed within days and the markets rebounding quickly. Similarly, there were some recurring European auto tariff threats between 2018 and 2020 that consistently created market jitters, but subsequent recoveries. And obviously, most recently, in a big way, there were broad, large-scale tariff announcements that have been slowly brought back in response to market turmoil. I think it's important to understand what's happening beneath these short-term market moves. Markets aren't randomly fluctuating. They're rapidly adjusting corporate earnings expectations. And traders are attempting to profit from these short-term fluctuations. And basically, when you see prices go up and down quickly in response to new information, that's just the real-time adjustments in those earnings expectations and confidence in those earnings. So if you're a long-term investor, though, you really don't need to be overly concerned with short-term changes in earnings, even if those changes extend for multiple quarters or even several years. Because policy changes can indeed impact earnings for several years, but investing is fundamentally a multi-decade endeavor. CEOs and shareholders alike, they like profits, and policy shifts are akin to changing the rules of the game. Once businesses understand these new rules, they quickly adapt and strategically try to remain profitable. In my conversations in recent weeks, I think this is perhaps the biggest misunderstanding many investors have about how policies impact markets. Long-term investors are effectively business owners. Reflecting on my own experience and that of my clients who own businesses, nobody is saying, I think I'm going to sell my business because of policy changes or economic uncertainties. Instead, the prevailing sentiment among business owners is to weather these periods of uncertainty, adjust strategies, and focus on running the business profitably in whatever environment they face. Now, another major misunderstanding among investors when discussing policy changes, I think, is the conflation of the economy with the stock market. These are two entirely different entities. policies can be detrimental to economic growth. I get that, both in the short term and the long term. But economic growth doesn't directly correlate with stock market returns. The primary reason for this is that corporations prioritize profits above all else. So if the opportunity to generate greater profits exists in other markets, companies will shift their strategies accordingly. And as you probably understand, many businesses aren't confined to the economies of their home countries. And yes, some companies will inevitably suffer losses due to policy changes, but this underscores the importance of diversification. Historically, only a surprisingly small number of companies are responsible for driving the majority of market returns in any given year. And so when you think, yes, there will be some losers, there will also be some winners. And the biggest winners are going to be the ones that drive all the return anyways. I think it's also crucial to remember that stock prices are forward-looking. They reflect the market's collective expectation of future earnings and economic conditions rather than the present-day current realities. And I think when you start to really understand this dynamic, it helps clarify why markets often react strongly and swiftly to policy announcements and reversals, but also how over the long term, they end up just being another blip on a historical chart of headlines and rising stock prices. I think there are some lessons for us all on how we can thrive amid policy whiplash. Here are 3 key lessons. Number 1, think like a business owner. Successful long-term investors understand they're effectively owners of the businesses they invest in. Just as business owners don't typically sell their business due to short-term policy changes, disciplined investors should resist making reactionary decisions based on temporary political or economic uncertainty. Remember, companies adapt and seek profitability under changing conditions, and your investments can benefit from this resilience over time. Lesson number 2, diversify to mitigate policy risk. While some companies or sectors will suffer from specific policy decisions, effective diversification helps protect your portfolio from the outsized impact of these isolated disruptions. Diversification basically just ensures that you're broadly exposed to a relatively small percentage of businesses that consistently drive market returns, regardless of short-term policy shifts. Lesson number 3, understand that markets are forward-looking. Short-term market volatility often reflects rapid adjustments in investor expectations about future earnings and economic conditions, not a clear indicator of long-term investment prospects. Investors who maintain a disciplined approach, recognizing that markets continuously recalibrate based on anticipated future developments, position themselves to avoid costly emotional decisions. And by maintaining that discipline, thinking long-term, and remaining diversified, investors can effectively manage volatility and turn market disruptions into opportunities. Navigating market volatility, regardless of the reason, but in this case driven by policy shifts, requires patience, discipline, and perspective. Short-term disruptions like those associated with the taco phenomenon remind us of the importance of maintaining a long-term investment focus. By understanding the difference between the economy and the market, embracing a business owner mindset and staying diversified, investors can effectively manage volatility and position themselves for enduring success. If you enjoyed this episode, please consider leaving a review. It helps others discover the podcast and allows me to continue delivering valuable insights. As always, thanks for listening, and until next time, to long-term investing.
Thanks for listening to the Long-Term Investor Podcast. To access free financial resources and submit questions to be answered on the show, visit thelongterminvestor.com. Peter Lazaroff is an employee of PlanCorp and BrightPlan. All opinions expressed by Peter and any podcast guests are solely their own opinions and do not reflect the opinions of PlanCorp or BrightPlan. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of PlanCorp and BrightPlan may maintain positions in the securities discussed in this podcast.